We'll explore how to design your insurance premiums around your needs so that you can avoid unaffordable premiums and save substantial money over the policy lifetime. So let's first understand what we're protecting. Effectively, we're covering one, a few, or all of these different scenarios. We call this the disablement process. We cover these scenarios with one, a few, or all of these different types of insurances, depending on your budget and aptitude to risk. Health or medical insurance allows you to skip the public waiting list and seek private hospitalisation, surgery, or treatment. Then there's disability cover. This pays you a monthly benefit if you can't work due to serious illness, injury, or bodily degeneration. It kicks in after a wait period that you choose and continues until you're able to work. Trauma cover pays out a lump sum of money if you suffer from one of 40-odd serious illnesses or conditions. Cancer, heart disease, or stroke is an example. Total permanent disability pays a lump sum of money if you cannot work ever again. And lastly, life insurance pays out a lump sum of money if you pass away or are diagnosed terminally ill. Health insurance is most likely to be claimed on, and life insurance is least likely to be claimed on during your working years. So let's next understand the problem people are having with these insurances so that you can avoid it. Down this column is the average age Kiwis start realising their mortality and start buying these different covers. This column down here is the average age people are cancelling their covers. As you can see, it's not too long thereafter. And this column here is the average age people are claiming on the covers. So statistics show people are cancelling their covers before their claiming years. So why are people cancelling before they're claiming? There are two types of premiums available. The first is called a stepped with age premium, or yearly renewable term. And the second is called a level premium. We'll start with the step premium. A step premium, as it says, steps up with age. And because it steps up with age, it should really be utilised for insurance that's only needed short term or less than around 10 years. Either that or for insurance benefits that reduce over time, like life insurance that's put in place to pay off a reducing mortgage, or for those at a stage in life where their budget is limiting them to a step premium. But the problem is most people are being sold a step premium in New Zealand even when their cover is needed long term. This graph shows $500,000 of life insurance all the way from 30 to 70 years old. The chance of claiming increases as you age, so the insurers increase the stepped premium with your age to cover their increasing risk. There are other factors as to why your premiums increase, however we'll just focus on age-related increases at this point. Whether it's health insurance, income protection, mortgage repayment, trauma, disability, or life insurance, a step premium will look similar to this graph over time. Generally, Kiwis are paying for a stepped with age premium because they simply haven't been shown other options. Options that allow them to structure their premiums to their needs and retain their cover through the years they're most likely to claim. Furthermore, with most policies I come across, the benefit amount is set up to increase with inflation. So the benefit amount is increasing with inflation every year on top of the age increases. If left to run without any maintenance, with only a 2% inflation increase, the premium looks like the red bars instead of the blue bars, which we looked at the previous slide. Often the need for cover is reducing as well over the years, but the benefit's set to be increasing. So the cover is simply not structured around people's needs. So for simplicity, let's go back to the graph without inflation. Research tells us people are cancelling their covers because of the unaffordable cost of the cover, not because they don't need it anymore. Their insurance premiums have been set up to work against them and not for them. You can see at 30 the premium is low, and through the 30s there's a very slow increase. The premium goes from $37 per month to $44 over those 10 years. It increases slowly at between 0 and 5% every year. Then through the 40s, the cost goes from $44 to $99. And increases start speeding up to between 5 and 10% every year. Then during the 50s, the premium goes from $100 to over $300, and increases accelerate to between 10 and 12% annually. Finally, during the 60s, the cost goes from $300 to an amount that's not sustainable for most incomes. Premiums are increasing between 12 and 15% by that stage. So from the age of 45, premiums will double every 5 to 8 years. This is aside from any inflation adjustments or extra claims the insurer experiences. The second type of premium is called level premium. It's illustrated by the green bars. This premium is best used for insurance that's needed long term or over, say, 10 years. Or for situations where the buyer just prefers certainty of cost. Now, we often structure insurances that are needed until retirement, for example, income protection or trauma insurance, as a level premium. Level premiums for income protection type covers are only offered by specialist life insurance companies in New Zealand, but they're standard for insurers in the rest of the developed world. This graph shows a level versus step premium projection for income protection. This level premium that doesn't go up with age allows the insured to keep their protection affordable and therefore keep it in place while paying substantially less over the policy lifetime. If you add the two premium types up over the policy lifetime and compare them, the cumulative difference in this example is over $43,000. To know the total or cumulative cost of the cover is really important when you make your decision. Measuring the total cost over the policy lifetime helps you ascertain whether it's a worthy investment or not. As a consumer, having access to know the total cost is not a legal requirement in New Zealand, so make sure you find an advisor that will disclose this to you. Both stepped and level premiums have their place. When I help you design your plan, it's a process of 3 stages. We determine, number 1, what types of cover are best for your situation. Everyone's different. And then secondly, how much of that cover and for what purpose. And then lastly, but most importantly, how long you need it for. Asking how long you need it for allows us to strategize with the correct premium type for your needs, and is the consideration that's usually left out when dealing with a bank or a broker. You have the option to split each type of insurance up into different benefit amounts as many times as you wish. This example shows the total life cover amount of $600,000 split into a $500,000 portion and a $100,000 portion. You can then apply either a stepped or level premium structure to each portion, depending on the purpose of the cover and how long it's needed. So let's say you need one portion of life insurance to pay down the mortgage for your other half if you pass away. If your mortgage is $500,000, your life insurance benefit could start at $500,000. Then you may need another portion of life insurance of $100,000 to replace your income for a year. These amounts are just examples. If you passed away, the beneficiary would receive the total $600,000. So for the first portion of $500,000, let's imagine you're 40 years old and you plan to pay down a mortgage over the next 20 years. The mortgage will look something like this over that period. If your mortgage is going to look like this, the portion of life insurance you're buying should be decreasing every year along with your mortgage. It usually suits to apply a step premium for that portion of the insurance as it's cheaper cumulatively. We can talk about that in person to see if it suits you. But instead of letting it run away with age and inflation and having insurance sitting there that's nice to have but not necessary to have, reduce the life insurance every year with the mortgage. The step premium stops increasing at the rate it would otherwise and will instead look like this. This way, it will remain affordable over time. By simply adjusting or reducing your life insurance to your mortgage every year, which only takes a couple of minutes every year, you'll save a lot of money over the period you need the insurance. The mistake is taking the set and forget approach, which will make the $500,000 that you originally set up increase with inflation and age and look like the blue premium comparatively. This is what most people are doing. And it eventually leads to people making unwise decisions to cull their insurance. It's usually when they get their renewal notice in the mail. Only buy what you need from the insurance company. For the second portion of $100,000, a level premium can be opted for, which is going to remain affordable and therefore in place over time. This portion you may choose to leave increasing with inflation so that $100,000 will be the equivalent of in 20 years' time. So we take the strategies I've just taught you and apply them to the insurances you think are necessary. Level premiums are available for income protection, trauma recovery, permanent disability, and life insurance. Elsewhere in the developed world, this type of tailored approach is expected by the consumer. We're on catch-up in New Zealand, but people are catching on. Unfortunately, health insurance is only available as a step premium. I can show you strategies to keep this cover affordable as well. When I help you set up your insurances, the primary goal is ensuring the cost will be sustainable for you over time. As without sustainable premiums, the odds are you won't have the cover in place when you need it, and it's a potential waste of an investment. The structure of your cover is as important as the cover itself. You now know how to avoid buying insurance with a premium type that won't serve your purpose. My service is free with no obligation, and most importantly, I manage claims for you.